Let me tell you something that will shock you today. There's something the CRA does quietly that many people don't even know exists, and it can cost you serious money if you're not prepared. It's called deemed disposition. Let me break it down. So deemed disposition just means that even when you don't sell off your assets, CRA can still pretend that you sold it and then tax you on the gain. Yes, you didn't sell, but CRA will act like you did. Now let me give you examples because that's where it gets real. So example 1, let's say you bought a condo in Toronto 4 years ago for $500,000. Life changes, you move to British Columbia and decide to turn that condo into a rental property instead of your personal home. The moment you convert it from personal use to income generating, CRA treats it like you sold it, even if you didn't sell it. So if the condo is now worth $850K, they will tax you on the $350K gain just because the use of the property changed. So if your marginal tax rate is 20%, you owe CRA $35,000 just like that. That's deemed disposition. Second example, you have a house which you bought several years ago for $400,000. Your child is getting married, and as a wedding gift, you decide to gift the house to your child. If the market value of that house today is $900,000, CRA will treat that act of gifting like you sold it at the market value. So just like that, you owe $50K in taxes because you gave a gift to your child. Third example, in Canada, when someone dies, CRA pretends you sold all your assets the night before. But if you have a spouse, they let the assets roll over to them tax-free. But if no spouse, your heirs may inherit the assets, but first CRA takes their own share of the unrealized gains. Fourth example, you leave Canada, maybe you move back to your country of birth and become a non-resident. CRA pretends you sold your non-registered assets such as your stocks, ETFs, business shares, and other investments that are held in non-registered accounts. So if you invested $70,000 in a non-registered investment account and it grew to, let's say, $120,000, CRA would tax that $50,000 gain as if you sold everything the day you packed your bags, even if you did not sell anything. But assets in your registered accounts like your TFSA, RRSP, RESP, and other rental properties are not taxed under the deemed disposition when you leave. Listen, building wealth is not just about making money. It's about understanding the rules that can take it from you. Don't let CRA catch you off guard. If you have assets in Canada, you need to understand what happens when life changes. Now, if you want me to break down what deemed disposition means for your investments or for your future plans, just comment yes and I'll walk you through it. Don't forget to like, share, and follow for more finance content.